the trade tensions and the VIX spike is the reason investors are a little cautious, but I don't think that's going to change that markets still have a lot of tailwinds into year end. And part of it is AI is like, I think demand is accelerating there, and we know that investors are sitting on a lot of cash, and institutional investors are really having a terrible year. Only 22% are beating the benchmark, so I think there's a bit of a chase. And then sentiment has flipped negative, which is always a contrarian buy signal. So, I think despite this mounting wall of worries, including the shutdown, I think it sets us up for a pretty good rally into the end of the year.
Tom Lee begins by acknowledging the obvious. Investors are nervous. Between trade wars, government shutdown fears, and a recent spike in the VIX, it's no surprise that sentiment has turned bearish. But here's where Lee flips the script. He argues that negative sentiment is actually a bullish contrarian indicator. Historically, when investors are cautious and sitting on cash, markets tend to climb that wall of worry. Lee points out that institutional investors are underperforming badly this year. Only about 22% are beating the benchmark.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So what's your take on everything that we are talking about now daily?
Well, I heard the earlier segment, Scott, and I do think I'm kind of more in the Jamie Dimon camp, that, and Steve Leisman's point that there's opacity in private credit, and that's the problem that investors are going to grapple with for some time. And I think that, along with the trade tensions and, the VIX spike, is the reason investors are a little cautious. But I don't think that's going to change that markets still have a lot of tailwinds into year end. And part of it is AI is like, I think demand is accelerating there, and we know that investors are sitting on a lot of cash, and institutional investors are really having a terrible year. Only 22% are beating the benchmark, so I think there's a bit of a chase. And then sentiment has flipped negative, which is always a contrarian buy signal. So, I think despite this mounting wall of worries, including the shutdown, I think it sets us up for a pretty good rally into the end of the year.
It sounds, though, like this is enough on your radar that do you think it's at least changed the game in the near term for the market?
On the private credit?
Just overall. I mean, if there are continued issues in private credit and the leveraged loan market, then the stock market's not going to take that well. I mean, you wouldn't think.
Yeah, I mean, Scott, the only thing that I don't know is how many chapters it's going to take to play out, because, there's opacity, which is what is scaring people, but then there's real credit deterioration, which I don't think that's what's happening, and I think that's why Adam and all those had called it idiosyncratic. I'm kind of in that camp because high yield spreads have behaved. So I think it's more of is the flow of capital, because I think one of the biggest sort of allocations for alternatives has been private credit. It's going to make investors pause that, maybe this market it's not as easy a return as it looks.
You told me, I think, a couple of weeks ago that 7,000 on the S&P by the end of the year was realistic. Do you still think that we could get another 5%? That's what it looks like. It's 5% between now and then. Do we have that in us?
Scott, I mean, 5% is just an average fourth quarter from 1950 to 2024. But we have the Fed easing after an extended pause. So that's 1998 and 2024. So I think that 5% might be the base case. I bet you it's going to end up being more like 7 or 8% or even possibly 10%. So I think 7,000 is the low end of what we could end the year at.
Wow. And how much do earnings have to do with that?
I mean, earnings are going to matter, but it's been a good start. I mean, we're barely into earnings season. The banks have been good. 82% of companies are beating. There's a lot more visibility of demand and then less concerns about tariffs because we're kind of working our way through it. So companies have a better sort of visibility over the next 12 months. I think the outlooks are going to be good, and I think that's going to help stocks. And, I think there's a lot of room for multiples to still expand. So I don't think this market's that demanding.
I think it's interesting that you suggest that you'd be a buyer of regional banks and small caps. Why
Yes.
are you willing to do that? That's not putting your toe in the water. That's like putting the bathing suit on and jumping in. Why?
Well, I mean, Scott, I know there's a lot of muscle memory for people from 2023, and that was because of a big change in rates that really caught a lot of banks offside just in their business model. But that doesn't mean that this crisis, which is underwriting being done properly, should have the same issue. So I think that there has been a throw the baby with the bathwater out on the regional banks and the small caps. So yes, I think despite the fact that the Russell had a rough week, I think they're really going to be one of the beneficiaries. I mean, even on earnings basis, small cap earnings are going to grow 48% in the third quarter. That's like 5 times bigger than the S&P. So I think there's still a lot of growth left there.
I know from a market perspective, you think both gold and the S&P 500 can each hit 10,000 by the end of the decade. I'm not a math whiz, but that's only about 4 years and 2.5 months from now.
Right.
Why so bullish?
Well, look, on the stock side, the economy has proven to be remarkably resilient. We've seen 3 years now where we've had the most widely anticipated recession of all times that just didn't happen. And notwithstanding all the shocks that the economy dealt with and continued to grow, I think the economy is going to remain resilient. I think we may continue to have these rolling recessions that affect different sectors at different times, but the overall economy, I think, may very well continue to grow through the end of the decade, which I, by the way, call the roaring 2020s, because so far so good. It has been roaring. I look for earnings to get down up to over $450 a share by the end of the decade and apply a 22 multiple, and you get to something close to 10,000. Gold and stocks have a very interesting relationship. On a short-term basis, they're inversely related, but on a longer-term basis, their trends have been nearly identical. And I think gold is increasingly viewed as the safe diversifying asset that you want to have in a portfolio. It's definitely a risk-off asset, whereas Bitcoin is proving out to be more of a risk-on asset.
Yeah, Bitcoin's made a lot of people a lot of money, but it is down about 21,000 right now from its highs. So you've got to be willing to HODL, as they say, hold on for dear life and kind of ride that train, while gold just kind of quietly continues to make new highs almost every single day. It's been remarkable to watch. And by the way, silver too.
Correct. Well, I think there is a lot of wealth on the global basis, and I think a lot of that wealth wants to be diversified. Stock prices have soared around the world. We've had a global bull market. It hasn't been just the United States. People have a lot of wealth tied up in the markets now, and they want to diversify, and gold has kind of been sitting there for a while, but clearly gold is also a very good hedge against geopolitical risk. Maybe gold's down today on just some profit taking. Maybe it's because Trump is talking about getting together with Putin and Xi. But central banks, I think, are going to continue to buy gold. I think Chinese investors who lost a lot of money in the property market in China and have gotten whipsawed in the stock market there, I think they're buyers of gold. And I think Europeans are buying gold. You know, it's kind of like Bitcoin. There's no interest, there's no dividends, there's no earnings. So you can almost imagine whatever you want to imagine that it goes to. But the reality is there's clearly a global demand for both kinds of assets.
You know, you heard President Trump mention the possibility of a meeting with President Xi of China, saying they want to meet, we want to meet, talking about hopefully there at some point an end to this war. Let's go to the former, Ed. And, you know, listen, neither of us is geopolitical strategists, but if we get that meeting and a photo op and the two, Trump and Xi, are smiling and there's a favorable de-escalation to trade, is that another leg up to the market, or has that in your mind already been priced in?
Well, I think ever since we had Liberation Day in, April 2nd, and that was followed by Annihilation Days and Trump then postponed the tariffs, the markets come to conclude that Trump's going to get this thing resolved one way or another in a way that's good for the United States. And if it's good for the United States, it's probably going to be good for for many of our trading partners. But it's still an ongoing situation, ongoing talks. We have yet to hear the Supreme Court rule on whether these tariffs are even constitutional. So that could really start to stir things up maybe whenever they get around to it. But all in all, I think the president's successes on the international stage are a positive for everybody, and certainly a positive for the stock market.
Lee acknowledges that parts of the market, especially AI and data center stocks, are showing late-cycle trading behavior. Some pre-revenue names are up 300% to 600%, similar to what we saw from October 1999 to March 2000. However, Lee doesn't see this as a bubble yet. He thinks AI capital spending is paying off, with hyperscalers like NVIDIA, Amazon, and Microsoft generating massive returns on investment. In fact, the biggest risk, he says, might be that their returns are so good they keep raising capex even higher, scaring value investors who don't believe in the long-term productivity gains of AI.
Are you dialed in on credit and loans and all the things that people are talking about outside of the stock market?
It's definitely coming up in a lot of my meetings. It's polarizing. I think most people, the consensus among the institutional investors is this is going to pass. We're going to get locked in on earnings. I don't even think it's next week. It's the earnings the week after. Like all the big tech stuff, Visa, MasterCard, kind of more like 10 days from now. So I think people are thinking maybe, a little bit isolated, some of the...
Idiosyncratic. That's so you would answer before I brought you in, I said idiosyncratic or, more to worry about. You go with the former.
I think it's gonna pass pretty quickly. I do.
What makes you believe that?
I just think we're not seeing it from the bigger institutions. So our view is own the large cap, higher quality banks. I think the regional banks are more of a economically sensitive interest rate play that I don't love right now. They're more likely to, be affected by loans that are bad. I think the big guys can absorb 50 million losses here or there, and you don't see it. I don't even know if JP Morgan, bends over to pick up 50 million. So, I think it's probably not going to affect the bigger banks as much, and I think that's a safer way to play it. On the flip side, I think the earnings season from the big banks, which was really before the whole, First Brand and Zion stuff, was pretty darn solid, right? If you look at it, generally upper revisions, a little bit more provisioning, but they didn't do as much last quarter. I kind of looked at the bolus of the big bank earnings and thought they were pretty solid. So I can kind of stick with that. As the thing that I'm most focused on. I mean, Jamie Dimon's saying the consumer looks like it's pretty good. Monahan at Bank of America. If you look at what they're saying,
but he also talked about cockroaches when it comes to credit.
Totally,
right?
Yeah. And I appreciated that sense of humor. But I think if you kind of look broadly across lending and demand for loans and what's being borrowed and what's being returned, it still looks pretty good. So I think the answer is the way you pitched it, it's more idiosyncratic. I think by the middle of next week, we'll be talking about Mag 7 earnings on the horizon, Visa, MasterCard, the other consumer, and we'll be back to the AI focal point. I mean, Taiwan Semi this week, a little bit ignored, but pretty good numbers. So I think there's enough in the fundamental positive camp that we'll get through this. Credit is always going to be considered the canary in the coal mine after a huge rally in stocks. Sure, it makes sense you get a couple days of fear, but as you see, people want to own the good quality names into what I think is going to be a pretty good earnings season.
Wow. And the Mag 7 are going to remind us why we want to stay with those names?
Yeah, I think so. I think the earnings season is risk-reward skewed to the positive. I think the biggest risk I see is that the return on the hyperscaler capex is so good they raise their capex even more. And so the school of people that are out there that I'll profile by saying older value investors have been more skeptical of AI productivity than younger growth investors. Obviously, there's exceptions, but I'd say that's how I'd cluster the group that I talk to. And I think the older value investors would say the return's obviously not that great, the capex is crazy, ultimately that's going to be bad. They may be right for the wrong reasons if the capex goes up. I think it's more likely the return is awesome for a while, and that the companies want to spend more capex, take the cash flows down to zero or negative, and so you could get a little kind of freak out on that. But I think ultimately you're going to be back to this stuff works and it's good and things can go higher.
What about the idea, even if you dismiss the credit issues as being not even to the level of systemic, but even more of a worry than they are now, does it tell you in any way about where we might be in the cycle? That when you get to a certain point in the cycle, you start to have issues like this because you talk about excess, the incredible demand for leveraged loans, and then the lending standards are lower closer to the end than the beginning. I mean, how do you look at that?
I'd answer that a little bit differently, and I want to make it seem like I'm talking on both sides of my mouth, but there definitely are late cycle trading signals happening. If you look at like the number of stocks that are up 100% or more in the last 6 months, and just things that maybe everyday investors don't look at, Oklo, or just the huge moves in these names that are either pre-revenue or don't have a lot of revenue. Rigetti in the post-quantum, cryptography, quantum space, Ionic. Like the moves have been massive. Bloom Energy, like anything with any AI data center sort of dream is up 300, 400, 500, 600%. So you don't see tops blow off things like that as part of a normal way. And so actually the note we're working on for the weekend, we write one every Sunday, is let's compare this to the October 99 through March 2000, just on some of the trading dynamics. I don't think that's the exact thing is where we are in the lending cycle. I think we're still earlier there. I still think private credit demand is going to grow. I think people are putting products together for that. So I think we're earlier in the credit cycle than we are on just some of the kind of crazy valuation trading.
Finally, Lee reiterates that the credit cycle is still early. Private credit demand will keep growing, and while smaller banks might feel more pain, large cap banks like JP Morgan and Bank of America remain strong. He notes that these institutions can absorb tens of millions in losses without even bending over to pick it up. In short, no systemic risk, no credit contagion, and a bullish setup for earnings season ahead. As he puts it, by mid-next week, the conversation will shift back to Magnificent Seven earnings, Visa, MasterCard, and AI dominance, the real engines of this market.